whose perspective of risk? My sense is that when we are looking at from a corporate manager point of view, their perspective has to be that they should be able to manage growth with stability. And in this environment, it's not an easy task. It's a very, very difficult one. Yeah, the second part, and I'm coming towards the concluding part of my discussion. Then we will take those up. The most important variable here is interest rates. Look at the universe. If there was no gravity, and suddenly you are transported to a universe where there is a gravity. This was the interest rate chart during 2019. All the red areas are basically the negative interest rates. We haven't heard, we haven't seen, we haven't experienced. This was 2019 chart. That means that you pay the bank money to keep the money in the bank. Okay. You get less money back after 1 year, 2 year, 3 year, 4 year. It's opposite of your discounting your cash flow. Okay. So your entire finance superstructure, on its head. This is today the only one. 2024 charts shows only Japan. Okay, and look at, for example, is that in 2007-8 we had seen that money came from dollars, came from yen, came from all over the world to India, and you have double whammy, which is basically that saying on the one side you have stock market returns, on the other hand you had the appreciating currency. So you have a really double benefit. You had a return of 15% and also currency appreciated by 5%. So your return goes up by 5%, is 20%. Now here you have a situation wherein yen carry trade can still carry on. But next one. As I told you, this is the most important rate in order to put the risk in perspective. Next one. Zero interest rate policy to new interest rates. We have lived for a very low interest rate for a very long time. I told you that it was like a living without gravity. Now, managers, corporate managers, people in general, investors, we are not used to high interest rates. So when you're taking a corporate decision, saying zero, and today you suddenly find yourself in 5-6% kind of environment. 5.5 is Fed funds rate. So your borrowing and lending is going to be higher. Okay. Next one. Post 2022, interest rates have risen. Now, and one logic today, for example, of increased employment, output, etc. in US is given is that as interest rates are rising, the people, the retiree people and other people are having their incomes gone up. As interest income they earn, and because of that, there is a spending and growth in the economy. But my sense is that in order to adjust mentally to a regime of higher interest rates will take quite some time to alter their behavior. Look at debt market, for example. We only have seen 2 casualties recently of the rising interest rates. I think bank failure because treasury losses. Now, at this level, the youngsters, those who are 30 or 40, in USA we had seen a bull market in debt market from 1981 onwards. So all, investors like me, fund managers like 40 to 60-year-old, they haven't seen any negative, portfolio so far. How do you adjust to this environment is going to be key to your survival in today's, whether you are a fintech, all the corporate principles would also apply to fintech in a much lesser way, but I think gradually as you become a standalone entity, you are piggybacking on somebody else's back right now, but tomorrow when you stand on your own, how do you behave with respect to interest rates and risk? How do you manage these two and look at growth in future? That is going to determine your future. So that is my take, that interest cost and risks, These will be two critical variables for fintech and any corporate finance manager to manage in order to succeed in business and creating what you call the business value or maximizing the business value. I'll stop here. I think taken a long time. Thank you so much for your patient listening. And if there are any questions, I can take that.
Good afternoon, sir.
Good afternoon.
So, like you were talking about Paytm, how it faced ban, temporary ban by RBI, and now it is collaborating with Axis Bank. Only today morning, my Paytm ID was changed from @Paytm to @Axis Bank. So, will it able to succeed in future, maintaining all the regulatory security and other things?
Well, collaboration is only to ensure that the banking wallet which was stopped by the regulator. So to the extent is that its business which was impacted would not get impacted in a way. However, from an independent entity to riding piggyback on Axis Bank, there are two different points of view from a Paytm perspective. Okay, so I would say whether it will be able to ward off all the compliance related issues, that's a moot point. Because actually, if truly they are they are compliant, they need not worry. But since they were issued in instructions in 2017, 20, and subsequently, it means that to focus on growth, because today there is a huge regulatory cost, and this is one of them. You've lost business it was 900 rupees share price, which has fallen to almost about 300 rupees. Okay, so effectively your business, in fact, survival is at stake. So my sense is that the compliances and regulatory part, for the sake of growth, should not be overseen, because there is a greater today regulatory part I did not cover in great detail only for one reason, because the regulatory landscape is it's still work in process. They do not know. I mean, ultimately, and it's not going to be regulation only by one country. It's going to be global. Today, for example, one cybercrime takes place in somewhere using the data somewhere or platform. Okay, where does the jurisdiction lie? Those are some questions which are which among the, I think, World Bank, even the local authorities, etc. Same thing is about crypto, for example. So compliance related issues, whether we get sorted out with the Axis Bank part, I'm not very sure about it. May or may not. Win-win for both, yes, as from business perspective. Yeah, that's right. Because I think from a Axis Bank point of view, it gives access on their that's right. Axis Bank gains more as compared to Paytm. Yeah, thank you. Yeah.
Good afternoon, sir. Sir, as the economy is going to fintech era, as you are already aware, sir, can you please give us the brief about what are neobanks? And also, Paytm has also termed as the neobanks.
Neobanks. See, neobanks is a concept which basically offer digitized services. They don't have physical spaces technically. Okay, so I think neobanks as of now, I don't think there is any licenses given so far. To me, it seems is that in India, RBI is still working on the framework to issue licenses to new banks. Effectively, how will they it will play out? As long as it stays only within the framework of saying digital payments and digital lending, then they're not adding anything new technically, because Bharti Airtel, Geo Financial, or all the IT companies would be providing those services that they have a significant database also with them of their own. So neobank, we need to actually know the contours of when the licenses are issued. But as of now, they may be using the existing banks, their infrastructure, to ride on piggyback on their infrastructure backend, okay, and show the face as saying we are the new bank. But they are using the infrastructure or the ecosystem of the existing banking system. So it will be some time before new banks are on their own, at least in India. So, no, actually, see, there is one point is very clear in the sense that industrial houses will not be given banking licenses It's very clear. Now, so question is that if they are trying to look at is that some group is looking at a backdoor entry. Okay, so I think regulator will be very wary of it because it poses significant systemic risk. Okay. In the sense that, for example, banking funds are public funds. Now those funds suppose get diverted to because even NBFCs they run the same risk because they become big, and suppose the funding goes to their own group much more than significantly, and then you put a system at risk. And RBI and then so significant regulatory aspects are involved here. I think I have no answers technically whether it will be or will not be. As a regulator, going by Kotak experience, okay, they'll be very wary about because they don't want to create a situation wherein that they fall flat. Okay. So RBI as an institution will be very very strict, and I think they'll take extra care not to go something in a hurry. They'll be very cautious. Yeah. Thank you.
Good morning, sir.
Yeah.
Sir, my name is Lakshya Agarwal. Sir, I have a question regarding, sir, does fintech helps and enables better access to capital, especially for startups and small businesses? And sir, do you recommend the young entrepreneurs to adopt fintech services in their very early stage of startups?
See, access to capital. Access to capital is a very difficult point. Whether fintechs, because fintech, for example, when you're saying fintech is only providing a digitized platform, wherein ultimately money has to come from somewhere. So, like MSME, I was reading about MSME. They are trying to serve the MSME segment. Ultimately, why MSME funding is difficult? MSME funding is difficult, for example, is that the businesses, they require funds, and their business is not able to generate enough cash on its own in the initial years. Okay. Now, in that situation, unless there is, they act like an NBFC on their own, I do not think fintech can really solve the problem of funding for MSME just by providing a platform or just by providing a market space for funding. Now, that's the first part. Now, who will give the fund? Now, the question comes is that ultimately, whether institution A, whether it's institutional funds, banking funds, who is going to fund MSMEs? MSMEs have already opened those, financing options to them. If they are not able to access those funds, how fintechs can make those accessible? That's the point. Now, without adequate collateral, they are saying they will use additional data. Okay. Now, one argument given is that they use data points other than, for example, the P&L account. Okay. Now, every data point which you are using is ultimately relating to the credit worthiness of that particular institution. Would you lend to someone who is less credit worthy? Surely not. So, two aspects very clearly. That one is that to a segment where they will not aid in terms of funding. They can enable, in case there is some other, you could create a fund which is an MSME fund, then fintech can probably use their resources to access those funds and provide a resource to the MSME segment. Now, regarding the student being part of, in the early part of fintech, see, it's a great field, but please be aware that large part of fintech will fail. When you say will fail, in the sense that one is that because you need money, whatever you are trying to create, the process of disintermediation is taken off. Large part. You still have space. I'm not saying that it's all over, but unless you really have ability and you study the market well, I do not think that it's going to be very easy for anyone to get into a space and make it big. Okay. Because to my mind, wherever, like digital lending, for example, it's not as easy. I'm not talking even pricing. So you have say 10,000 rupees with you or 10 crore rupees with you. Okay, you want to lend to a retail segment. Okay, how do you decide what rate? Would somebody borrow from you at lesser than what bank is giving? Now you need to look at your own business model. How would, for example, somebody who's supplying you money at what rate? and how the looking at our overheads and the mechanism, your digital platform or application or process. Okay, how does it really solve the problem with respect to lending? What is not solved by the existing setup? Okay. So be careful, study it, and if you find it's useful, I think there's no. I would say don't stop yourself, and I think take a calculated risk. Okay. But don't jump into saying is something saying I need to do it. Okay. So that is not, it's not a compulsion. If you have an idea and you think is workable and you have thought it through, okay, then you can take a risk. Yeah. Okay. Yeah.
Good afternoon, sir.
Hi.
Here. So, do you think the traditional banks will eventually replace the fintech companies, or they will coexist in the financial ecosystem?
As it seems that I mentioned also is that neither banks nor fintechs, they will go away. So they will coexist, and each one. I mean, today, for example, my sense is that some fintechs will grow and become big. Take, for example, intermediation business. Zerodha grow. Okay, few people have become large. They have say million accounts. They have opened. There is a reasonable size revenue, and some others will also exist. So traditional brokerages, with discount brokerages, with these online players will coexist. Now, banking to the extent is that whatever business is taken away by these fintechs, banks will try to protect their turf, at least the private banks and more nimble ones. But to me, it seems that because some part of financing business is done better by fintechs, so I think efficiency ultimately, both in terms of raising money and in terms of delivering those finances, will actually decide that which part of fintech and which part of banking will sustain. Okay, so that's going to be a game of extreme competition, and the customer will be the beneficiary. That's my assessment on that. Yeah, thank you.
Good afternoon, sir. Sir,
See, 10 years in today's time, today's uncertainty is extremely high. To say that 10 years, if I can say that I will know what 10 years later will be, I will not be able to make that assessment. However, I would say that going by the developments of previous few years, if one is to project as to what is likely to happen, uh, my sense is that efficiency at the level of banking and fintech both has to move up higher. Survival is going to be the name of the game. How regulatory landscape across the globe focuses, like for example, users will be far more conscious about, say, issues like data privacy, okay, which I mentioned. Okay. If suppose cyber crime, cyber frauds, things like that start happening, it'll put the trust deficit which was earlier with the banks. You might see a same situation here. Okay, you have something in the wallet, for example, with a XYZ Z company, and suddenly that fintech it disappears, it loses money, and your money is lost. Okay, then the same thing can happen with this one. But one thing is for sure, in the sense that we are going to the zero interest rate or negative interest rate scenario is gone, and we will see a situation wherein we need to adjust to a higher interest rates, and how we manage those risks to business and in fintechs. Both areas will be very very vital for continued growth and serving the customer. So it's going to be a tough call because business life cycles have changed very much. So it's a 10 year is a long time, but I'm saying only the efficient and the cost effective service provider, they will succeed. Otherwise, because funding is going to be tough. So today the startup which said will fund you because my interest cost is negative. So even if I don't make money for 3 years, I'm fine. But today my cost is there. So investors, I need to give return. So I can't, in my portfolio, I can't afford to lose money. So it's going to be tougher for funding, and similarly, you can't really keep on testing the ideas. So it's going to be a much more selective areas and efficiency driven. That will be the call.
Sir, could you please enlighten us about KPM and how we can use it in practical life?
CAPM.
Thank you, sir.
CAPM is, one of the core areas in saying a portfolio management. Although now there is multiple variants of CAPM, but I think effectively single factor. It basically the market risk, although APT and subsequent. My sense is that while industry still uses CAPM, I told you alpha, for example, when you say generation of alpha and a concept of beta with respect to saying a systematic risk only, okay, and risk-free rate. Practically, I haven't seen very much, although you test out saying portfolio beta is less than 1 or more than 1, etc. But practically, I think people are not too much focused on saying, take the case of diversified portfolio. Okay. And I think, can you tell me for a diversified portfolio, what is the alpha would be? If you take a diversified portfolio of a random portfolio, which is diversified, well diversified. I mean, I'm not talking about buffet diversification, which is 4 stocks are good enough, but I'm saying 20 stocks from across the sectors. What would largely, alpha would be? It will be close to 0 because alpha will be close to 0 and beta will be close to 1. So in any diversified portfolio, that's how simply they say, when you're looking from a fund management point of view or a, alternate investment point of view or any other portfolio point of view. So for a diversified portfolio, your alpha, because when we say efficiency, the market being, efficient, those who exploit inefficiencies, like people like Jim Simons, they say inefficiencies are small and short in time, which they exploit. And they have mechanism, and they have been able to generate significantly high returns. But broadly, markets are efficient. So you can't make extraordinary returns. So if you just have a diversified portfolio, so from a practical point of view, to the extent knowing, yes, my portfolio beta is this, or because even beta itself is not stationary. If the stationarity of beta is under question, the time period you take, okay, in order to assess that, it is not very easy to use these concepts in practical life in terms of portfolio construction. Nonetheless, CAPM is still useful from the point of view of saying just to assess riskiness vis-a-vis the market. So I will not brush it saying it's not useful. Yes, useful, and it tells you that if you are in alignment with the market, you are likely to get market returns. And ultimately, your effort to get extra market returns require an additional effort on your part to find out those market anomalies, which I think behavioral finance people today are realizing is that you are not rational, particularly from the point of view of making investment decisions relating to money. And I think several people have demonstrated that. So limited application, but nonetheless, it's useful from a practitioner's point of view. But single factor. I haven't seen the multi-factor model wherein you have segregate the factor betas. I mean, nobody has really. They're not going to specialize in terms of saying is that want to have an extreme degree of saying 1.73 is this beta is because of GDP moving or small or large firms kind of a John Greenblatt. Everybody has created their own niches to win the market without CAPM also. That's it. That's to what extent it helps that.
Thank you so much, sir.
Thank you. Thank you.
Thank you, sir, for sharing your insightful words. As we reach to the end of our keynote session, let's invite Honorable Dr. Rakesh Khurana, sir, advisor, MERI Group of Institutions, to share his insights. Over to you, sir.
Dr. Ashok Agarwal, faculty friends, students. I must admit that after a long time, I did not sleep in a 2-hour session. And I was glad to see that the students did not leave, that they were able to sustain, relatively speaking, complex subject. And this is all the complexity which is there about the finance. Nothing much more is there. He has summarized it so well. He himself admitted that he is an acknowledged expert in mutual funds, securities management, and so on, having been the MD and CEO of such companies. But he will try to combine, because we asked him to combine these two subjects. Fintech is the flavor of the month and years, and corporate finance goes on, and it will go on even now, and therefore how these things will vary. It is the kind of perspective he has given that actually younger faculty or older faculty can't give. He is in the middle of it. When he was a student at IIM Ahmedabad, I was a teacher, and I studied finance in the year 1971, coming from electronics engineering, and I thought finance was. But whole life it has gone. And incidentally, I was on the board of the same companies, ICICI, then Escorts Investment Trust, which runs the. A lot of people don't know the mutual funds can't make money. Investment Trust is not a profit-making company. And the manner in which he did, and every manager in that position has to do, is what the regulations are, what the owners want, what is good for the customers, and try to align it. That is the management. And second is that which board member likes what, dosa or rasgullas or parathas or something. And if not he himself, an assistant would make sure that they all get it in the lunchtime, so that they go home happy and just sign whatever the minutes are written. So he's good at that also. We actually, in a sense, I did not know much about the finance, but got onto the ICICI Limited as it became a bank. And our board meetings, both at the ICICI and at the Scott Investment Limited, used to be like very good finance seminars. People were so knowledgeable. Actually, I often thought that knowledge of the people who are there in the finance sector is not fully utilized by the industry. Be that as it may, I think he's done a great job. But I would have liked this session to go on for another 2 hours, right? So, on your behalf, can we ask him to come again for 2 more hours? What do you say? Yes or no? Good. With that, I on behalf of all of us, convey our vote of thanks. In NCR and Bombay, etc., it's become like this. You come for a 1-hour session and you spend 4 hours in traveling. That's a solid waste of time. So, good people, we should get them for 2 hours to 4 hours. So that some compensation is there. So next time also, I hope we will be able to do that. We will have a separate session with the faculty this afternoon, where faculty will interact, finance faculty will interact with them. Because it's very difficult to find a combination of somebody who is very good at his job, day job, and then also at the academics. And Dr. Ashok Agarwal is one of them. Thank you very much for coming, sir.
Thank you so much, sir, for your kind words. It's our privilege and honor to extend a heartfelt gratitude to our esteemed guests. As a part of our tradition, we felicitate our guests with token of respect and gratitude. For that, may I now request Honorable Dr. Rakesh Khurana Sir, Advisor MERI, to felicitate Honorable Dr. Ashok Agarwal Sir.
Thank you all. And I can see the vibrancy, the enthusiasm among the students, and that reflects the success of this seminar. We are really honored to have Dr. Ashok Agarwal with us today and taking out time from his busy schedule and making the session so interesting. In the whole journey of this session, there were a lot of things to learn, and it reminded me of my days when I used to teach business environment, and it was something like that only. Right from microeconomics, Baumol theory to ISLM models of Keynesian theory of disequilibrium, everything you have covered so well. And then coming down to AI, IT, and talking about Fintech and their future, all so well covered, and taking the case studies of Enron and all those. And it was like very enthusiastic, sir. Thank you so much. The way you covered it, CAPM, alpha, beta, what they actually mean. Because we read a lot, we teach a lot, but how they are actually evaluated, and how just without doing the calculation, we must know that if a diversified portfolio is there, what alpha will be, what beta would be. If anybody asks me if I am sleeping, I should be able to answer. So that tricks you have given to the students. Thank you so much for articulating it so well. We are really thankful to Professor Dr. Rakesh Khurana sir for making this happen and for arranging this seminar. Thank you so much, sir. You are adding a lot of feathers to MERI, and we are really blessed to have you as our advisor. We are thankful to our Vice President, sir, in his absentia, who agreed to it, as always, standing by our side, making this happen. Thank you, Chandani, for organizing everything. You were marvelous in organizing it. Thank you, Swati, for anchoring so well and guiding Chandani how to go about. Thank you, Shikha ma'am, Ajay Jain sir, Sadanand ji, Sangeeta ma'am, Ishwar sir for escorting and managing everything so well. Thank you, Pooja ma'am, for gracing the occasion. Thank you, Nyogi sir, for being here with us today and gracing the occasion today. Thank you, Sarita, for taking out time even with so many stresses of NAC and everything. Thank you, students, after all. Thank you, Atish, Manu sir, Pooja, Ajay Rawat sir, and all of you to very well organize it, and to the PNs and to the hospitality and housekeeping staff also for these. And this I really thanks, sir, for wonderful fragrance of jasmine and rose flowers. Thank you, sir. Thank you, students. Hope you have enjoyed it. We'll continue with these kind of sessions of speakers of eminence in different areas, but we need your support. If you will attend it with the way you have attended it today, we'll continue with it. So your support is very, very important for anything to continue. Thank you.
Thank you so much, ma'am, for your kind words. And thank you all for your active participation. We hope you all had a productive learning from this session. This session concludes here. Have a wonderful day.